How do interest rates affect the Contango futures curve shape? Imagine you're looking at a line that shows how the price of a commodity for future delivery compares to its current price. This line is called the futures curve. Sometimes it slopes upward, and that's called contango. Other times it slopes downward, which is called backwardation. Today, let's find out how interest rates influence this shape. Interest rates play a big role because they affect the cost of holding a physical commodity until the future delivery date. This cost is called the cost of carry. It includes things like storage fees, insurance, and the interest paid on the money used to buy and store the commodity. When interest rates go up, the cost of financing the inventory increases too. That means traders or investors who buy and store commodities need to pay more in interest. As a result, futures prices for later dates tend to rise compared to the current spot price. This makes the futures curve steeper and more tilted upward, which is what we call a stronger contango. Think of it as the market expecting higher prices in the future because it costs more to carry the commodity now. On the flip side, if interest rates fall, the cost of financing decreases. This reduces the overall carrying cost for holding commodities. When that happens, the futures prices for later dates don't need to be as high compared to the spot price. The futures curve flattens out, and the difference between current and future prices shrinks. For investors, understanding this relationship is key. When interest rates are high, the cost of rolling over futures contracts increases. That means if you buy a futures contract today and want to sell it later, you might lose some of your gains because of the higher costs. Conversely, when interest rates are low, rolling over futures contracts becomes cheaper, which can make holding these positions more profitable. So, in simple terms, higher interest rates push futures prices higher for future dates, making the curve steeper. Lower interest rates do the opposite, flattening the curve. This dynamic helps explain why the shape of the futures curve changes over time and why interest rates are an important factor in understanding commodity markets.